there is one investor that we met, a family office, and he liked everything. He said, it's a phenomenal team. I mean, he looked at all the badges that we had, Google, Paytm, Flipkart, so on and so forth, co-founder, all of that. And he said, I'm willing to kind of write a reasonably large check. I just want one change in your strategy. And the change was, he said, why don't you start a company instead of a VC fund? He said, okay, that's not going to happen. Right?
Hey, Sanjay and Vishesh, thank you for coming onto this podcast. I mean, we're obviously, Ajay and I are super excited to have the two of you. And I think we were just discussing before this, is surprising that the two of you have heard of each other but haven't spoken. So good to see that this podcast is bringing the two of you together. But thank you for doing this. And I think we'll keep it super informal. I think the goal is we want essentially people to know, like, how do you start your own VC? It just feels like it's this cliff, right? Like there's this perceived sense that, man, it feels like a lot of money. How would I ever go about raising a round? Does it even seem like it's accessible to someone to start their own fund, right? So I thought it'd be cool we thought it'd be cool to kind of broach on this topic. So Sanjay and Vishesh, both of you have started funds. I mean, I've heard actually, Vishesh, we had met in 2019, but we play Frisbee with Narayan.
Okay.
Before he busted his knee or his... Yeah. And so kudos to that. Obviously, seems like they're doing really well. And Sanjay, I mean, I think by the time you had already started your fund, you'd invested in like a bunch of companies, I think like 30, 40 startups. So would love to hear, how did the journey of starting a VC happen? Was that always like, man, when I turn 40, it's going to happen? Or was it like, this seems like the right moment, let's do it?
So I'm not 40 yet, so that wasn't the milestone.
My bad.
My journey was a bit different, and of course, each one has a unique journey. I started my career in venture capital back in 2007 when I was 23. I joined a venture fund and I spent 10 years with them. I sort of sunk my time, my career into learning that trade and working on that. And I think I was sort of deeply passionate about, having this ability to look at multiple things and get excited by multiple things. And at the same time, have an inside view to how founders build companies. I was fortunate to having been able to do this at a very early stage of these companies, their 0 to 1 journeys. And I think that's what really stuck on to what I want to do for the next 20 years. And Arjun, my co-founder, has also he's been more an entrepreneur than I have, and he's been a builder all his life. So that two of us came together to say, hey, we want to set up a pre-seed seed fund that invests in very early stage companies, typically first check in. And the other part of our DNA ethos is that, we want to work with founders who are doing things that are ridiculously hard to do from a science, engineering, software, hardware standpoint, wherein essentially there's a lot of tech moat and founder moat that comes into building these companies. Narayan is a classic case in point that you mentioned, that has sort of built Ultraviolet and now at a stage where he's delivering bikes to customers. So that's sort of how we sort of got out there and started. So for me, the shift really of starting this own fund was just a gradual progression of what I did for a decade, saying that, hey, I picked up learnings from there, wanted to build an institution that lasts its time. And one of the big things you keep seeing in our venture world is there are new firms, there are new spin-offs. So desire for us was to really say, hey, can we build something that will last time, that will last 3, 5, 6 funds, that can see another generation of GPs take over? It's very aspirational in thinking, and that's what led us to where we are.
Nice. Sanjay?
Yeah. Hey, first and foremost, thanks for having me here. I think this is my 3rd or 4th podcast that I've been kind of part of. So thanks for this. Very different journey from Vishesh. So absolutely not from the industry, right? In terms of the VC world itself, always thought that was a dark side when I worked with companies, right? So, but what got me here was possibly the 20 years of work experience, right? So I worked with large corporates like Google's and Intel's in product and consumer marketing. Somewhere in 2007 is when I joined. My first start was Myntra. I kind of ran marketing for Myntra very early. It was Series A invested at that point in time. That's where I met Raveen, who was also the co-founder and an early investor in Myntra. And then worked for multiple startups, some not so successful, some fairly successful. During the journey, I kind of gathered few things about how do you build a digital first kind of company out of India, right? And you had the luxury of working for Myntras and Flipkarts, wherein it was fairly well venture funded. And thereby you kind of saw that. And there were also companies that I worked for where it was not very highly kind of funded, and thereby the struggles. Also looked at, during that time, who are the founders who really kind of make the cut? How are they able to kind of scale? What are the broad, framework with which they operate? And relatively some not so successful, right? I actually kind of did my own kind of startup in between. I kind of joined another founder, very, very short-lived, worked for a year and kind of moved out. Also learned in terms of how do you really, the hard way in terms of founder chemistry, right, out there. So on and so forth. Then I think 2017 is when I started investing personally into companies. And about 25, 30 investments later, kind of decided that this is something that I really, really kind of enjoy. And most importantly, kind of saw consumption-led kind of, consumption, if consumption in India is going to increase, and because of digitization, can we as an operator who understands this space kind of invest very, very early and also operationally kind of help founders. And that was a theme. That's what at least I thought. And I kind of had the same thing shared with Raveen and Bhushan, who are the two other partners in the fund. And both of them are again operators. Raveen had co-founded 3 different companies. Bhushan was the president of Paytm. Prior to that, he was with Alibaba in China. But I've known each of them for 12, 13 years. And over one evening, and this 30-odd companies that we invested was our own personal check, right? It was a common pool that we put together. And that portfolio did well. And one final question to each of us when we were kind of taking different calls in our own career was, what is it that we want to do for the rest of our lives that we'll enjoy? And pretty much, common, we said, maybe we should kind of look at an early stage kind of fund. And one evening that got settled and we said, okay, jump in with some bit of naivety in terms of what is it to kind of start a fund. We kind of talk about the details of that much, maybe a little later. But we said, okay, that's how Multiply was born. And we said, we're going to be an operator-led fund looking at consumer tech in India and largely, kind of focused on that. Yeah, that's how we were born.
Let's talk about that actually, both of you. What's the naivety that you went in with and then operating now in it for, let's say, quite a few years? What's been the reality?
Yeah, and it'll be interesting because I think Vishesh, with that background, what really took you by surprise?
I think there's still a lot of naivety despite any background when you're doing venture. And the naivety also comes because sometimes as a founder and you're starting something, you're not going to necessarily think it out in detail for 20 years ahead, right? Clearly, Arjun and I didn't do that. We said, hey, we want to do a pre-seed seed fund. We want to have some money to deploy in science and tech. Because we read up the rules, we wanted to do an AIF chat too. We can talk about what that means later. It said you needed 20 crores. So the first step was, let's find a set of guys that can get us the 20 crores. We can start writing checks. Because we're in business. You can have a conversation with an entrepreneur saying you have a fund. So that was all that was up there when we wanted to get started, right? And hence the naivety comes from, what it takes to build a fund, scale a fund, build a team, scale the team, build a brand, build an identity, stand out for something, then work on the community side.
Yeah.
And then have a generational VC firm that's able to transition to the next level of partners and build and scale. So that's the, 5 years later, you realize that you still have all of these things to solve for. And then, the naivety slowly vaporizes and all the reality around you is here.
Yeah. And I'll kind of, what we didn't have in the team was somebody like a Vishesh, who had kind of spent some time in investing, right? So 3 of us here we were on the other end kind of building companies. So we understood product marketing, consumer marketing, product and tech. And whatever success that we had, or at least perceived that we had, was this 30-odd investments that we had put in small angel checks. And, they did reasonably well. And we said, now what, we can start a fund. So getting the name of Multiply Ventures was easy. And from there on, as we kind of went into the path of, this is a very funny one. So we said, okay, we're going to start a fund, how big the fund should be, right? And we didn't know what to say. and we all kind of wrote a number that we liked, and it was 250 crores. And
all of you got it spot on.
And we said we're going to do 250 crore fund, right? Absolutely clueless in terms of how daunting that number was. It was our first fund. And we said, okay, we'll kind of start the process. And when I said naivety, it's everything from, we didn't know that you'd apply to SEBI. We said from, you're angel investors, now you can kind of start a fund. And somebody told us there's a process to it and you need to kind of get a license from SEBI. So one after the other, we kind of followed that process. So the naivety in every step, right? But what we did in the entire process was, because we worked with VC-backed companies in the past, we did have access to some fairly respectable VCs in the market. So we kind of spoke to them, then kind of understood in terms of what it means, how long does it take to kind of launch a fund of this size, so on and so forth. So every step was for us learning. So we kind of learned the hard way in terms of how do you kind of build this. And we finally got a license to operate the fund March of 2020, right? And
after what? 18 months?
No. So it took us 6 months to kind of get the license.
Okay.
Yeah. So typically it would have taken a typical fund 3 months. In our case, because we are first and a whole bunch of questions that we had to kind of answer. But what we kind of understood is, so there's the entire process of how do you kind of go about for the licensing process, right? But as long as you're good with the asset class that you're dealing with, in this case, it was early stage, and we understood that reasonably well. And we had enough to kind of say that these are some of the personal investments that we have made, and why we invested in so and so. I think that was good enough for us to kind of get to that stage and the license, right? But then kind of starts again. We all kind of, this 250 crore number that we put for ourselves was where we had to kind of lots of time in terms of how do you kind of raise that amount of money. And I think the other naivety was we didn't know there's a thing called first close. You need to kind of do a first close before you can start investing.
What does that mean?
First close is the minimum amount that you, so when you kind of apply to SEBI and when you kind of get the license, there is a particular threshold post which you can kind of start investing. So typically it's about 25, 30 crores. You kind of say that I've got 30 crores of commitment from investors, and post which you kind of start investing from the fund, right? So the entire journey was for us kind of constant learning. And so when I said naivety, it was in the true sense. We thought the transition from running your own angel fund to this would have been easy because you just invest, but just the framework around that kind of made us kind of learn lots more, and the process took much longer than we kind of anticipated. So now I think, and we kind of got the hands dirty. Now I think if somebody were to kind of start a fund, I think we have clear playbook in terms of what mistakes you can kind of avoid. How can you kind of do this much more efficient way, so on and so forth. But that's where it is.
If you were to do it again, would you stick with that 250 crore number, or would you have changed that? Knowing what you know.
No, looking back, the fact that we did finally kind of, manage to get the 250 crores in. I think I would have gone back and stayed with the number. Possibly nice. Now that I've looked back, we could have done a few more better things in terms of how we kind of got our investors on board. I think we made some mistakes out there. So yeah.
Yeah, and maybe both Vishesh and Sanjay, you can chime in. How is raising a round or raising a fund similar to, let's say, how founders raise, let's say, a seed or a Series A? Like, are you going through the rejection process, which is, hey, for every 100 people you speak to, 3 you get that one in, and then it's like, oh, now it's a momentum post that. Like, how does that work?
It is a sales process at the end of the day. You're no different from a founder. We're all doing what Sanjay and I were building our firms. We behave and think and act like founders ourselves, right? At some point, you have to realize that you're not the only fund manager in town. There are enough fund managers in town. So you have to always go back and talk about what your positioning is, why you're different, and why you good or better or best equipped to execute the strategy you want. Venture's also maturing, so folks expect you to present a certain strategy, a certain approach to doing deals, and why you think you're good or you'll be able to execute it. So at some point, over time, you refine your story and you show the dots in the story as proof points. As Sanjay said, your earlier investments, the proof performance there, and all of that adds up. But yeah, do you hear enough no's? Absolutely yes, and things that you learn from.
Yeah, I totally agree with that. I think the fundraising for the fund, for me personally at least, and I think I can echo both Raveen's and Bhushan's view, was possibly the most humbling 18 months of our lives, right? Very late in your life, you kind of go through that journey. And our fundraising was completely during the pandemic, right? So we were hit, we got the license March of 2020, and third week of March, I think everything kind of shut down. And the starting line was then. I think most of the investors talk to you only once you've kind of got the license. Till then, you can kind of have conversations, and you're a first-time fund manager. So
can you apply for the license before you ever commit?
You can. I mean,
okay.
So, you can. So you can. I mean, the fact that you want to start a fund, there is a memorandum that you kind of submit in terms of investment thesis, strategy, so on and so forth. So that is kind of fairly well thought out, right? But once you kind of apply, then the entire process is still they give you the license. At least investors kind of look for the license. Otherwise, you can have those conversations, some soft commits here and there, but that's how it kind of starts, right? So for us, that entire fundraising process was, I have some crazy stories, right? So because I want to kind of share one. So there is one investor that we met, a family office, and he liked everything. He said it's a phenomenal team. I mean, he looked at all the badges that we had, Google, Paytm, Flipkart, so on and so forth, co-founder, all of that. And he said, I'm willing to kind of write a reasonably large check. I just want one change in your strategy. And the change was, he said, why don't you start a company instead of a VC fund? And we said, okay, that's not going to happen. Right? And he did kind of throw in a fairly large carrot. I mean, it's a fairly large ticket kind of investment he was willing to make. But he said, maybe you need to change the strategy of not starting a fund and why don't you kind of start a company? So I think we went through, all of that. I think it took much longer because of the fact also everything was virtual for us, right? But once you kind of, it is like a sales process. You kind of go to investors, you clearly have a thesis and a strategy to kind of follow on. And you kind of, at some point, I think, at least for us, I think we got better in terms of the story itself. We got better in terms of data backing our narrative, in terms of what is it in our DNA that we believe and our own space in this early stage in a kind of a VC ecosystem, so on and so forth. So we kind of evolve from there. As you kind of learn, you keep doing these things better to where we are right now. So I always say that it was a fairly humbling experience in terms of raising a fund, for a VC. Yeah.
Vishesh, you mentioned you raised a smaller round before. Like, was it, you said 20?
Yeah, our fund one was small. Our fund one was for 60 crores. Our fund two was 300. We're adding another 200 in the next fund. Yeah. Okay. We're always fundraising.
Always fundraising. Interesting. And
that's the only way to acclimatize yourself to that hard job.
And is this fundraising through golf and like lunches, or is this like more formalized fundraising?
No, I think a good way to fundraise is to show what you have and what you do. So golf doesn't help there. I mean, it may from time to time, but
sure.
But one good way to fundraise is to show portfolio, show companies, and to continue to talk through. And of course, I half jokingly said you're always fundraising because you're always wearing a sales hat, trying to display what your fund is capable of and what your capabilities are. But yeah, you can't always be fundraising from that standpoint. You've got to have an open fund, you've got to have a strategy, and you can't have multiple funds open at the same time. Simple things like that. But I think a lot of our fundraising, we've got half our companies that are building software and the other half that's doing science and tech. So often it's you're displaying capabilities that these companies have in terms of engineering or in terms of just tech and the cool stuff that they're trying to build. And that's one way to show that you either understand them or have the ability to underwrite them, or both.
Right. And actually, just coming back to the regulatory piece. So are you saying like someone like me or Ajay could just start a fund? Like, don't we have to show, or there needs to be like proofs that, hey, I might have, I don't know, is there like a guarantor like play or money in the bank to show that I need to start a
Or
fund.
Sanjay touched on having some sort of track record, I think, as well.
But track record versus,
I think you can cut this in multiple ways. If you want to raise a fund of reasonable size, and then you want to rinse and repeat that fund and build a strategy around it, and you have more than one person, then you go through the pain of setting up a fund, getting a license, working with the regulator, and do that, right? And in those cases, I think there are a whole host of conditions. At some point, you need to be able to sponsor a certain part of the fund, a certain quantum of the fund, and you need to sign up to saying that either you may have it already, or you will have it by the time the fund is set up, and things like that. So there are a bunch of conditions that need you to be able to show strength and capability to run a licensed product, because that license also allows you to go and market the fund to a certain audience and raise the capital, right? So there needs to be a certain amount of onus on your side of it. But the other part, which possibly hasn't been spoken enough on this particular call, is just how people have democratized access to VC funds, right? Be it AngelList or be it Let's Venture. If you're essentially a solo GP or one person, you don't have a large team, you don't want to have a large team, you're not sure whether you want to do it, then you don't have to go through all this, things that you can't unwind, which is to go to SEBI to set up a fund management entity, to set up a fund. And there, I think life is a lot easier. And there are structures that allows you to essentially pool in money as a syndicate and invest in a bunch of companies. There are pros and cons to it. There are folks that just do that, their own set of funds. And there are folks like ourselves that say that, no, we're trying to do something that will last its time, 3, 4, 5 funds, and hence we want to set up a fund. So there are both ends to it. Long story short, 10 years ago to now, setting up a fund, it's a lot more clearer. The playbook is a lot more easier. You also have the optionality to have a fund, but not set up a fund, right? Like what these the syndicates do on these platforms. I think it's a great time. It's a great place to be. Things like this weren't possible 10, 15 years ago, and they clearly are now.
Right.
If you want to set up a fund, Ajay wants to set up a fund, you don't have to do all of this. You can just get started by working on one of these platforms and see if it picks your liking, see if you're good at it. And then, like Sanjay and ourselves did, we built some track record on the side. And we call it track record because it's good. If it was bad, I wouldn't call it track record for myself, right? So
call it experience.
Yeah, you call it experience, you won't talk about it. Unless you're at a job interview or something. But yeah, so you do all of that. And then if you're sure this is what you want to do, then you go ahead, because the door out isn't that simple once you're in.
Yeah.
Right.
Good point. Yeah.
Fair enough. And it doesn't matter, let's say you said, like in terms of raising money, let's say the two of you, if you're raising money, like if you're setting up something in India, you're open to raising money from anybody in the world, right? Like you're not, let's say, necessarily localized to having to raise some like from.
And there's compliance if there's money that's coming from outside. There's compliance if there's money coming from inside. There are different degrees of compliance depending on where the money is coming from. But nothing stops you from taking outside money. That's your question.
Okay.
And at the moment you're kind of getting a license from SEBI to operate a fund, it comes the minimum check size, right? So if you're a SEBI registered fund, especially Cat 1, Cat 2, Cat 3, the different categories, 1 crore becomes the minimum amount that an investor can kind of put in, right? So your investor pool becomes very, very different, and the regulation and compliance piece is different. Versus if you have good deal access and you say, now I'm going to just syndicate deals on one of those platforms, then you can take smaller ticket size as well, right, from investors. So it's very, very kind of different. So yeah, I completely agree with Vishesh in terms of there are a whole bunch of avenues for one to kind of try this out before you kind of say that this is what something I want to do for a reasonably long period of time, because a structured fund is long. By nature, it's long. So it is a fairly long race, and one needs to be really committed to kind of, doing that. But there are platforms that you can kind of try and see if it kind of interests you before you kind of take that larger plunge.
Fair enough. How are you competing in terms of access today? I mean, the size, like I feel like, maybe I might be completely wrong, but like capital has become a lot more accessible, right? Like to your point, there's like your 1% funds today, you have Y Combinators of the world, which have now taking on 300 startups versus let's say 75, right? So how are you making sure you're getting access to the startups that you want to invest in? Is just positioning good enough? Because it's like, hey, I need to get access to the top 1 or 2% to get my massive wins, right?
It's a combination, in my opinion. So one is your positioning in the market. What are you, right, out there? So in our case, we are a consumer tech fund. We invest purely in 4 sectors. Fintech, edtech, retail, and health are the 4 sectors that we invest in. So very, very clear about that. Why consumer? Because 3 of us have spent pretty much 20 years plus in the consumer tech industry. So we understand that. So we said that's the first step. So we won't do anything that we don't understand. So I think that was one. Second is only early stage. So we do day 0, pre-seed, seed is our sweet spot. So Visa will institution, that's where we'll kind of come in. I think that's number 2. Third is we have a thesis. So even in the form of investment, we have a thesis across these 4 sectors. And thesis is more driven by, what are the gaps that we see in each of these segments 10 years forward, and kind of looking for founders who are kind of solving for it, right? So I think we are thesis-driven, sector-focused kind of a fund. I think that's your third. And the fourth is having been in the system as in leadership team in some of these companies, having invested in a portfolio, between 3 of us, we have possibly invested before we started the fund in about 70 odd companies collectively, right? So 30 together, few others individually. So, many have worked, many have not worked. Our own learnings in terms of why we chose consumer tech, right? So I think that's how your first level of framework is. And the second level of framework is, I would say it's about what founders see in you. Now I can kind of say lots of things, but founders need to at some point really kind of believe that Multiply Ventures, if it's consumer tech, I want to take money from them because capital is kind of commoditized especially in a very, very bullish kind of a market. But is there something else that you can kind of bring onto the table? I think those are softer aspects. I think we are possibly, people see us as operators even now who've become fund managers, right? So we believe that in the last 3 years of starting Multiply, I think founders share with us their vulnerabilities far more than a conventional, how they'll, with a conventional kind of a VC, quote unquote. So I think that's our positioning, that we are extremely founder first, that operator hat is something that we wear very, very seriously. And we are able to kind of help them that 0 to 1 journey in a far more meaningful way. And last but not the least, collectively, can founders start, giving you other founders that are kind of coming up. So lots of our investments have come through the founder network itself. And that's a fairly, I would say, filtered kind of a list that you kind of get.
That's a good
so
one.
yeah, we're still kind of, building that. But I think it will take some time for us to kind of, and fund life, I think your fund 1 is going to kind of dictate your fund 2 and fund 3, right? So you need to kind of stay with your thesis. You need to stay with your value system in terms of how you come across. You need to stay with what you promise versus what you deliver to a founder, so on and so forth. And then I think you'll find your own niche, right? So you'll figure out that there are X amount of founders for consumer tech in these 4 sectors, thesis driven, this kind of value system multiplies the person that I need to kind of go with. So you will figure that out, but it takes longer than, you can't just market yourself and say, it's not a PR led kind of a game. It's more in terms of founders actually going through the grind with you and them talking to other founders in terms of what you are. I think the DNA kind of comes through. So we kind of said for ourselves, saying that 5 years into Multiply Ventures' first fund, every good founder in the country who's looking at consumer tech, are we in the consideration set for them, right? And that's a good place to be in, right? But it takes 4 to 5 years journey to kind of be there. So we are on path. We're still kind of learning, fine tuning in terms of what we do. So that's where we are.
I think Sanjay very well articulated, the thought process that one would follow from, access. Yeah, I think the only incremental point I would add on top of that is, different funds have different strategies. Us, for one, have a concentrated strategy. So a fund typically has about 18, 20 companies. We have reasonable holdings and ownerships in that. We commit reasonable time to that. And hence, we don't have a concept of doing an optionality check or a co-investment check. If we do it, we really mean it. It has a significant piece of our fund at it, and hence it moves the needle for us. And hence, then what you also try and build is you try and go after a certain thesis, a certain sector, a certain approach. And it's very difficult to boil the ocean. It's very difficult for me to stand up and say, I want to see 95% of all the deal flow in this country. Practically not possible. I don't have the brand. I don't have the positioning. Then the question is, in a subsegment like deep tech, can I go out and in a subsegment within deep tech saying pre-seed and seed, can I go out and make a statement saying I want to see 60, 70% of the deal flow there? And in that, say 2 or 3 sectors, such as let's say carbon capture or let's say space, can I say I want to do 90, 95% of that because that's what I think is relevant. So as a young emerging fund manager, you don't want to go boil the ocean. You want to essentially go boil a glass of water, which is very reasonable to try and do.
Totally, yeah.
Fair. I think you both mentioned, Sanjay, you talked about being operators, and Vishesh, you talked about working with startups as well. What's that split between actually meeting with new founders and making those decisions to invest versus actually working with your portfolio companies and helping them grow?
About 1/3 each, when you begin with, but as your organization evolves, as you add more bench strength, more GPs, then you have someone who just largely does 60% of it, fundraising, networking, someone who largely does portfolio support. Firm like us are not there yet. So everybody does everything. So we just have a thumb rule of 1/3 each.
Yeah, likewise, even for us, I think the first 2 years was largely both fundraising as well as kind of investing. So we had to do both. Because contextually, we were also in the year of pandemic. So our fundraising possibly took longer than we thought we'll be able to do that in about 12 months is what we initially thought. It took us 18 months. So I think that's one. So we had to spend lots more in terms of fundraise, but parallelly kind of looking at building the deal pipeline. So I think that is one. To cut to where we are, third year, fund is kind of closed. It's kind of, and we said we'll kind of invest in 20 to 22 companies from the first fund. We're close to 20 already. So we've kind of done that now. So now the entire focus is kind of making sure that we're spending lots more time with the portfolio companies. And everybody's in different stages, right? So you have somebody who's still not figured out product market fit. How do you help them? There's some who've figured out PMF, but they want to kind of graduate to the next level in terms of scaling. So how do you kind of help them, so on and so forth. So we have different charters, but the team is the same. So that's where we are.
And I guess in terms of, I guess for simplicity, let's say the fund was, I don't know, $100, right? And how much goes into seed versus Series A? Or like, let's say you said pre-seed. Okay, actually, that's not a good example. But let's say let's say for simplicity, let's make it 100 mil, right? If it's a 100 mil fund, how much do you say I'm going to spend in terms of percentage towards pre-seed and then the following round? Or you don't even do like following round in terms of Series A, maybe?
We have a very fairly clear strat out there. I think that we decided on day one. So it's 35-65. So 35% goes into what we call the first investment or the first check, right? And 65% of the capital is for follow-on. So strategically, at least for us, what we see is we kind of invest in a company from seed all the way to Series A, right? And post that, because we're a small fund, we don't take part. We just take our pro rata, right? So, but what we do is whatever is the first check that we put, which is 35%, and the company does well, we also kind of invest, or if possible, we kind of increase our holding to Series A. And rest, all the follow-ons kind of follows after that. So 35-65 is the thumb rule for us. And we have kind of stuck to that, yeah.
Yeah, Sanjay is bang on. There's a lot of empirical data to say that you keep $2 to $3 for every dollar invested, especially if you're doing very, very early stage. It's not very different for us. We're doing the same thing.
And in, let's say a startup's raising 2 mil, right? Do you like it? Do you like to be one of the folks like, okay, like how do you decide in that 2 mil if they were the first ones to come in? They approached you first and they were like, hey, listen, we're looking to raise around. Do you say, okay, I want to put the whole 2 mil. I want to put, is the 35-65 applied there? Is it, I put 500 and let me kind of reach out to other VCs and get other folks involved? How does that piece work for you?
Again, sectorally kind of differs for us. So I think fintech, is different from retail, is different from health, right? In terms of, so typically what happens is we have two considerations, right? So one is we like the founder, we like the space, sectorally the thesis where it kind of matches. Just for an example, right? So let's take fintech, all right? So we've kind of liked everything. So, and we want to make an investment. So typically for us, the 2-3 things that needs to happen. One is the overall valuation match. If it's a seed round, so we kind of say that if it's fintech, it needs to be sub $10 million for us to kind of put the first check, right? First criteria. If it's a little overvalued, then we normally kind of stay out, right? So first framework is if you're kind of getting into an early kind of investment, valuations do kind of matter. So it cannot be way too overvalued. I think that's one. Number two is always your discussion is how much of ownership do you want, right? So you can typically kind of put a 250 to 500K kind of a check initially in a company that's raising say 1 to 1.5 million dollars at that point in time. So that's your step two in terms of that's a negotiation with the founder. Now, in the case of fintech, typically our ownership has been much lower because valuation even for a seed stage. Fintech always kind of has that large market size and thereby lots more innovation that could kind of happen versus retail is very, very different. If you're kind of building a consumer brand, it's very, very different in the way we kind of look at it. There we look for slightly higher ownership. You can take, for a same amount of money, you can kind of get that ownership, so on and so forth, right? So every sector, every company, it's kind of different. But finally, what happens is, there are many deals where we have kind of given the term sheet, everything has been agreed on, but then a large VC comes in, right, in the seed stage itself. And then, it's a fairly different kind of challenge because you've kind of given the terms, the founder just like you, but then now a large VC comes, with a fairly large brand and possibly a fairly high conviction check as well, right? They do believe in the story. Then how do you still kind of play the part of making sure the founder takes that money? How do you kind of still take part, a meaningful ownership out there and be kind of relevant in that deal? So I think those are some of the nuanced kind of, negotiation that kind of happens. But so we've kind of put a playbook in terms of sectorally, what is the minimum ownership that you need? What is the amount that you will kind of put? What kind of valuations are you okay to kind of stretch and kind of stay within that framework and not get carried away? But one more point that Vishesh kind of mentioned is, for us, conviction is number one. So we need to be, so we are largely, our learning has been, you cannot outsource that bit to a large VC. You need to be very, very convinced in terms of why you're investing in this company and just kind of, hold on to that, right? I think, and we have enough examples in the portfolio that we have kind of done that. So I think that becomes the other critical factor in terms of how you kind of invest.
Yeah, I think not very different. Just mathematically speaking, you've got 35% of the fund to make 15, 20 investments. Your best buy is your first buy because that's the best valuation. Of course, unless there's a down round after you invest, which is less likely when you're doing pre-seed stuff. Yeah, I think the only other thumb rule we have is, you hold off by not doing too much upfront. Like I would never put 10, 15% of my fund in a single check on any one round. It's just not very efficient de-risking given small funds that we run. So somewhere the balance is how much can you deploy? What is the largest check you can deploy in any one company in any one round or in the first round, which is like the first risk you're taking? And what's the best buy you can get for that to sort of give you, venture return supporting power law and all of that, yeah. And fund like us typically has 15, 18 companies with meaningful positions in. So, and if the round is too large, you still, in a market like this, you can't wait for somebody else's conviction, you've got to have your own.
Right.
So your decision is irrespective of who's coming, but sometimes it's still restrictive of how much you can do.
So let's say, it's good to hear.
So there could be a $3 million round where a fund like mine could go and say, hey, at best we'll underwrite 1/3 of it, but we'll underwrite it.
And then post that, I'm sure all of your relations, you have I wouldn't call it partnerships or relationships, but you're so ingrained in this space. I'm sure you already have you pass this on to a friend who's also running a fund and say, hey, listen.
Yeah, of course, you do that all the time. Everybody does that. Yeah.
Okay. And how quickly do you usually know? Let's say you already have a thesis formulated, someone comes in, it's like, hey, here's a relationship and these are the 10 things that I want from that relationship. And this lady appears, you're like, man, I know in the first 24 hours that I want to have a long-term relationship with this person, right? But how quickly has it ever happened that you met someone gone, man, within 2 days, we mostly want to invest in this company?
It happened with Narayan, I must confess. I've said this before in public forums as well. Ultraviolet was a decision that, we were quite convinced the day we met the founder. There was back in the day when I was 9, and I was much younger. Today, we take a lot more time and we're more prudent about it. We have other people's money we're managing.
Right.
Yeah, it doesn't happen that often. Yeah, sometimes you do walk out saying you're very positive. Everything that you want to see in a founder is there, or on the sector is there. You walk away with that, but you've grown old enough not to let people know about it.
Nice.
Similar
I totally agree with Vishesh. I think that some of the initial investments that we made was, I think we saw it. So when you're an angel investor, right? So when you're actually a good angel investor, I might add the word good, right? When you're a good angel investor, it is you invest. All the investments have been because we liked the founder, right? And we liked what he or she is kind of building. And you're putting a very small check at that point in time personally, knowing very well that this will either work and the company will kind of build, and thereby long term, you might have a financial reward, or there is a good chance this might not, and you still need to kind of hold on to that relationship. And it's just a capital that you put, right? And if you go with the same mindset into starting a fund, where you have actually not managing your own money, which you're okay to write off, but you're managing somebody else's money, right? So I think you need to kind of very clearly kind of, tell yourself every day that you're just a fund manager. You're managing somebody else's money, and there's a massive, massive fiduciary responsibility to kind of make sure whatever you decide, it might be overanalyzing, but you need to kind of analyze much more than what you were doing as an angel investor. I think the first learning for all the three of us was, putting those, playbook and guardrail and questioning each other, right? So each of us kind of lead a particular vertical. But if I'm convinced, then how are the other two kind of looking at it, right? So you kind of really poke holes, and I need to be convincing enough to my investment committee. There's a committee that finally decides whether we make an investment or not, and lots of hard questions are asked there, right? So that's the way it is. But there have been many moments where we have collectively liked a founder, and we are like, what Vishesh had with Ultraviolet. So we have similar kind of few companies where we just liked everything and it was so good to be true. And we said, we need to invest. And we've done that. And as we've evolved, I think we take now slightly longer time. I think we do analyze much longer than what it used to. But I think it's a good thing. I think it's important to kind of do that as a process. Yeah.
Sweet. So actually, I want to get more in terms of, I feel like maybe the VC space since 2011 in India is like really starting up, right? Like just that as a financial instrument and as a vehicle, like the amount of money that's coming in, it's only going up. And sure, there are like some downturns and things like that. I'm curious to hear. Obviously, clean tech's picking up, and like e-commerce has shown, I would say, some form of validation in terms of for VC funding. Where are the subsectors or the subsections that you're seeing, which is exciting? So, let's say not like clean tech, but let's say within clean tech, is there something? Or let's say space, but within space or within edtech, what are you seeing, right? Like, I'd love to hear. If you have some examples as well of like startups that are doing something interesting they already invested in, that might be cool to hear as well.
So let me kind of do that. So we are a consumer tech fund, right? So, and why it is very critical is, why we chose this is possibly one of the few countries with all the things happening in the world, give or take, we are going to be 6 to 7% GDP growth over the next, say, 10 years. And 2/3 of that GDP is going to be consumption-led, right? So we are largely very similar to kind of China. If India needs to grow, so whatever has happened in India over the last 18, 24 months, if you look at stock market, look at inflationary pressure that's kind of come in, what has kept India going is internal consumption. Right. We are a very, very strong domestic market right now. Right. So for us, when we said we are going to be a consumption-led fund over the next, say, 10 years, it was largely kind of pinning on the fact that in India, it will kind of grow. And in that, these 4 sectors are going to be very, very core, which is health, education, your consumer spend, which is retail, and fintech, right? So we said there's enough and more for us as a small fund to kind of have our own clear niche and kind of do that well. So I think that's the first level. So for us, whatever excitement that we see in this fund or next is going to be a derivative of these 4 sectors, right? So I think that's the way we are kind of looking at it. So we are not going away from it. So that's one. And second is, and I keep going back to this, we understand this relative to other sectors. We understand this sector pretty well. So we said we'll kind of double click on this itself. I think that's true. Now, within that, now if I kind of look at some of our own learning experiences, there are a bunch of companies out there that we invested in, which we thought, we invested for a reason, but the growth and what the founders have kind of figured out in terms of playbook has been very, very different. And for us, it's been a massive, massive learning, right? Maybe an example of that could be, so I kind of run the retail vertical, which is the consumer brands part of it. So we look at both consumer brands and e-commerce enablers, but consumer brand is where we have made a few investments. And we invested in this company. Again, this is one of those companies that from day one, we liked the founder and what he was kind of building, the company called Illuvia, which is in the beauty and personal care space. But interestingly, very different. It was not a direct-to-consumer kind of a play. This company was kind of looking at a very different kind of, I would say, benchmark. Wanted to kind of build, what L'Oreal Professional did for the salon industry. Highly research-oriented kind of product, deep chemistry is what they kind of look at, so on and so forth. One of the co-founders was regarded as a extremely good chemical engineer from VIT. Started from VIT and kind of came to kind of building this. But when we spent time, and the entire thing was we liked what the founder was building, but the entire theory was about how can science solve for beauty and personal care, and how do I kind of sell this, not necessarily direct to consumer, but I'll sell it through the salon network. There is an assisted buy process out there, and the first problem I'm going to solve for is hard water related problem, starting from India and across the world. So hard water is a massive problem. I have a range of shampoo, conditioner, and serum that solves for it. And we kind of sat with him and he told us the chemistry. It was a pure chemistry class in terms of how the product kind of works, right? And he said, I don't need X number of SKUs. I'm going to have just clearly 1, 2, and 3 in each solving a very large use case. And that's the way the brand is going to be built. But I'm going to sell through a B2B2C kind of a network. And none of us, and you can see my hairstyle, I've never not been to a salon for a long time. So for us to kind of understand that bit, work with the founder to kind of really figure out the efficacy of the product, so on and so forth, took some time. But it was brilliant in terms of, then we kind of have this thesis that you can still build a consumer brand, but a very, very different kind of a channel to kind of look at, which is in this case, a salon network, right? So that's, again, an example of, I would say, you can have sectorial views, you can have thesis, so on and so forth, but a founder might kind of come and say, I'm going to kind of do this very, very differently. So what we look for is, largely, is there an IP on the product? Is there a differentiated distribution strategy when it comes to retail? And if brand needs to be a moat, how long the brand always takes some bit of time, are we kind of looking at the brand narrative itself, right? That's how we have in terms of, on the retail side. Similarly, we'll kind of look at fintech with a different lens. We'll look at edtech in a different lens and health in a different lens. So for us, we are still bullish on these 4 sectors. We're not going to go away from that, at least for this fund and maybe even next fund. We might look at 1 or 2 going forward, but possibly we'll add someone else in the team to kind of look at that.
Before Vishesh jumps in, at what stage was Illuvia in, for example, when they came to you with this? Because it seems like a very clearly laid out strategy, concept, go-to-market strategy, but how much have they actually tested?
Not much. So when we had kind of met, they were just coming out of pandemic. All the salons were shut. They had raised a very small round before that. They got a grant from VIT. Nice. So the VIT team kind of believed that there is this extremely good founding team that's kind of behind this, and they were at I would say they were just kind of scratching the surface in terms. There are few salons that used to kind of sell the product, and that's how they were. But the vision in terms of the new products that the team was looking at was fairly path-breaking in terms of, I think some of the products they're planning to launch this year has not been, at least one of the products is never, it's going to almost replace existing, one of the product categories in the salon network, right? I can't name it, but that's IP in terms of what they're kind of looking at. They have scaled, from X to possibly they've grown, I would say in terms of month on month, they've grown almost 20x in the last, say, 12 months, right? In terms of, a monthly revenue, so on and so forth. But most importantly is that, it's about the larger vision, right? So in terms of one of the few founders who on day one said, I want to build a company, take it public. And that's been my dream for a very, very long time. And thereby, where the journey is. So Illuvia is just one of those examples. We have few like that, wherein we kind of learn through the journey in terms of, what a founder vision is, right? You can have your own understanding, but you learn in terms of a fairly differentiated kind of view on the market itself.
Vishesh, any thoughts on sectors and?
We have two broad areas of interest to us. One is SaaS, and the other is just science and tech. And science and tech is just as broad as it is, right? And I think 2 or 3 things that we've stuck to foundation principles as we look at making investments and partnering with founders. One is, what do these founders know that most people don't agree with, right? That allows them to go and build contrarian tech, or allows them to go and build highly differentiated tech. Second piece is that tech itself should be very meaningful, very differentiated. I mean, we care less whether it's IP, trade secret. We care more about, going to sleep thinking that 20 other guys aren't going to wake up tomorrow trying to build this. And the third is, time is very overrated. We care a lot about just the rate at which time grows. You want to be in a market that's growing very rapidly and exploding, because that then becomes a very fertile environment where customers are willing to give you a chance. Like you're like the 500th product somebody's selling, then you have to find a wedge to get in and then build a position for yourself. You're among the first 2 or 3 guys that's offering something in a market that's just rapidly growing. There's a greater chance you're going to get a chance to test your product, put it out in the customer's hand, play with it, test it, take feedback, and go, right? So those are 2 or 3 things that we try and see in the company to make sure that we're getting comfortable with. Also, we don't like to stay too far away from the customer. So if I'm selling something to somebody who's going to sell something to somebody who's then finally going to go sell something to a customer, then we get very nervous, because then that whole feedback of what the ultimate customer wants to when and how and what translation comes back to us, often a lost in between, and then you're not able to build products the right way. The other unspoken thing that at our end is we learn a lot from the portfolio. Like, we learned so much from Ultraviolet. We went and built an electric aviation company. We learned from that to go and build a robotics company. We learned from that to build a battery company. From that to build a battery recycling company. Same. So we try and make sure we learn enough that allows us to go find the next company. And we hope to play on what we call information advantage, which is we know something that others may or may not know so easily. That allows us to move on a certain opportunity differently.
Right. Vishesh, to your point, because you guys are so deep tech, are you collaborating with a lot of these IITs as well, or like IISCs of the world?
Yeah, just like in any other part of the world, a lot of the tech does come from academia or a cross-section or convergence of academia and business. Not very different for us.
Okay. I guess my next question is more around the AI play, I guess, into the space, right? Are any of you, how are you viewing? Okay, 2 parts to this. One is, are you using any of these AI tools internally itself, whether that's from a content standpoint, whether it's an optimization play? And second is, are you seeing any interesting AI-focused companies outside of obviously OpenAI and ChatGPT? But how do you kind of perceive the two?
It's a very, very generic term. I know there's LLM AI, which is what ChatGPT and all of that is all about, and there's traditional AI, which you've been seeing for the previous era of the last 5 years, right? So let's answer it in parts. Do we use AI tools? Yes, we use AI tools. We use some AI tools for our meetings, which allows us to transcribe meetings or summarize some of our meetings, or get note taking, all of that, right? So yeah, we do use AI tools. Keeping LLM out, which is still playing itself out, and that multiple big boys playing different games out. Traditionally, we've seen AI, and a lot of our opportunities have been AI in the specific as against AI being generic. So we were early investors in a company called Wingman. They did voice and AI to help sales folks understand customers better, prioritize sales funnel. It's a sales intelligence company. We did in a conversational AI company in a company called TrueLark out of the Valley that essentially runs front office or front desk operations for hospitality, takes in all customer calls and does scheduling and things like that. So we've often seen higher accuracy and higher outcomes of AI in specific use cases. Because essentially AI is automating something or doing something that someone else was to do. And if it's truly measurable in an outcome, then it's a lot easier. So I think the first wave of AI, or the preceding wave of AI was all around that. And we've got a host of investments we've done in that space. The whole LLM play is playing out. It's also where big boys and big money is being put out. So we're seeing opportunities in the use case aspect of it as against the broad, let's just go build another LLM model and train it. That's not something we have the size to play.
For us, to your question, yeah, we kind of used a few, including as someone a generic as ChatGPT to kind of look at whether a content strategy is right or wrong. So I think that we've done. But the stage that we invest in, which is early stage, right? I mean, personally, at least for now, we don't think there is going to be a massive impact on from an AI point of view in terms of fund investing itself at an early stage, because there are lots more qualitative signals that you look from a founder, which I don't think at this point in time AI can kind of solve for, right? So I think early stage, I would say at least for some time, from an investment angle, whether AI kind of helps you or not from a fund point of view, I think it's still a little, I would say, some time for that to kind of happen. And for us, again, because we are a consumer tech kind of fund, so far we've not seen a massive impact out there yet, right? So we're going to wait and watch. Growth stage, possibly, yes. As a fund, you can kind of collect and have some prediction modeling in terms of for late stage funds as a data backup, right? So you can kind of do that. But early stage, I think AI would be not necessarily a massive impact, at least for now.
I want to come back. I mean, I'm maybe digressing a little bit, but have your team, what's the team structure today in the size that you're playing with?
For us, we have 4 of us. We have 3 GPs plus an associate in terms of core team. We have a fund administration team that is outside, which is kind of partners with us. We have a legal firm, we have an audit firm, and we have a couple of firms that does due diligence. So we have about 4 or 5 partners, but in terms of core team that manages the portfolio, I think we're just 4 of us.
Okay. Vishesh, I think you had mentioned 3 in Bangalore. And
we're 2 GPs, we're 9 people all in.
Okay. And does location matter anymore for the 2 of you? Like, you feel like you're able to do everything online and not have to meet the founder in person before you make the investment, or that's still, you're still like that before that happens?
No, not off late. I mean, ever since the market has kind of opened up, I think there are lots more that you can do when you meet the founder. We have made a bunch of initial set of investments during the pandemic when we haven't met the founder. It was all virtual. But early stage, I think and it's largely a founder bet at day 0, especially with just an idea and the founder. And it's extremely critical to spend some time with the founder. And thereby now it's almost mandated for us to meet the founding team, spend some time with them before we make a decision.
What are you looking for in that founding team when you meet them, especially day 0? Like, I mean, I feel a little later on, there's so much validation from the product and the company.
I think, so there are 2 parts, right? One is many a times when it's a very high, when you kind of on the initial meeting, when there is a spark that this is something that you want to be part of, is largely driven by 2 or 3 things for us. One is the founding team knows something about the market that you are absolutely not aware of, right? And we do lots of research before we kind of meet a founder. When a founder writes to us and says, this is what they're planning to do, when we set up a team, we do our own internal research, talk to some people before we kind of get into that call. We're fairly well prepared in the first call itself so that, the founder's time is not kind of wasted. So, and many a times the founder comes back to you with the way he or she sees the market, the way he or she is distributing the product, or the way he or she is going to build that kind of a moat. So that's 1. 2 is, I think most of our physical meeting is about value system match, right? So 3 of us, at least the way we are running the fund is, we're fairly frugal, we're fairly, in the way we're kind of approaching the fund itself. There are a bunch of value system, which is an unwritten kind of a code in the way 3 of us run the fund. And we want the founders that we back to kind of have that kind of a chemistry, because you're in for a long haul, you are going to kind of partner with this founding team. So I think that's largely in terms of conversation, you will kind of get from the tonality, from the body language, in terms of whether the overall chemistry, is there a chemistry at all, for you to kind of look at. And that's, I think that differs fund to fund, but we think there is a, clear value system that we have that we see in the founders as well. I think that's true. And third is, whether this founder is long-term oriented or not. And now I think we have still not 100%, but the more you kind of meet founding team, and the more you kind of learn from either a deal that you've missed or a deal that, you keep kind of learning through that and kind of really kind of try and kind of get good at long-term orientation versus short-term, right? I think that's something that you again get through your physical meetings, in-person meetings, and with different sets of viewpoints, 3 different sets of GPs kind of talking to the same founder, you're able to kind of exchange notes, so on and so forth. Those I would say are the top, 2 or 3 things that's important.
So completely agree with Sanjay. In fact, we don't believe in online even at our organization. We're work in the office every day.
Anyway, guys, listen, thank you so much for your time. I know the two of you, you had a busy Monday, I'm sure, but I'm pretty much done. Ajay, if you have any questions.
No, I think that's about it. This has been great. Thank you both very much.
Yeah.
Hey, super fun. Thanks for having us. Enjoyed. Sanjay, we'll catch up offline with you as well. Cheers.
Yeah. Hey, thanks, Anirudh. Thanks.
Okay.
Thanks,
sure. Take care.